to this call focused on multi-funder donor-advised funds. My name is Dario Parziale, and I'm the Managing Director of Programs and Operations at Tonic. As we are welcoming a number of new people onto this call, please let me briefly tell you about Tonic as the organizer, but at the same time, I would love for each of you also to share where you're calling from in the chat and the organization with which you are affiliated so we can get to know each other. At Tonic, we're a global community of over 512 individual, family office, and foundation asset owners who are seeking deeper impact in their investments and in their lives. We manage a community of over 500 investors in more than 25 countries with an estimated 25 billion of investable wealth. We serve our investors with a global community of practice, events that foster investor connections, investment opportunities, educational resources, impact support, and we also have a number of field building programs that we use to share actionable insights with the broader community. In that spirit of sharing innovation with the broader community, we're organizing this call focused on multi-funder donor-advised funds. We're very excited to open up this call about this new structure, multi-funder donor-advised funds, because for the past 2 years, we have seen this structure being replicated over and over within our community, with so many investors working together to make catalytic capital investments. Before getting started with the structure, though, I need to share a very quick disclaimer. Tonic is a not-for-profit organization and not an investment advisor, and the content that we are sharing today is not meant to constitute legal or tax advice. Before talking about multi-funder donor-advised funds, let's start with the basics of what is a donor-advised fund, often abbreviated as a DAF. DAFs in the United States are philanthropically funded investment accounts established at public charities. As you can see in this image, there is a donor that makes a donation to a donor-advised fund held at a public charity, and the donor receives a tax deduction in exchange for the donation. The donation goes into an investment account that can make investments, grow over time, and eventually donate some of the proceeds or all of it to charitable organizations. Traditionally, DAF providers in the United States don't offer many impact investment options to their donors. We believe at Tonic that this is a huge missed opportunity in our space, and we are really eager to work together organizations such as Impact Assets that have been at the forefront of providing impact investment options to their DAF clients. And so this is why we're partnering with Impact Assets on this webinar today. In this specific webinar, we're highlighting multi-funder DAFs that consolidate philanthropic donations from multiple investors with the objective of collaboratively invest. So instead of a single donor, we will have multiple donors that invest together in the same investment account. In a few minutes, one of our presenters, Tim Frederick, will tell us more about how this happens, and then we will have 3 case studies to show multi-funder DAFs in practice. There are multiple reasons why we believe this innovation is so important in our space, and I would like to summarize 3 that I believe are the most important ones. First of all, multi-funder DAFs are a great enabler of catalytic capital, and by catalytic capital, we are referring to those very high impact investments with an expectation of sub-commercial returns that unfortunately don't attract sufficient capital from commercial investors. Since donor-advised funds are philanthropically funded, investors often have more flexibility on their return expectations. Also, multi-funder DAFs can promote the collaboration among donors to screen multiple investment opportunities together, collaborate in due diligence, and leverage expertise of co-investors. And finally, investments made through DAFs often have fewer legal and tax compliance requirements for cross-border investments. This can facilitate investments in the global south by lowering their transaction cost. These are some of the reasons why multi-funder DAFs are getting more and more traction within Tonic, and we're very excited to see this collaborative investment vehicle being established and replicated elsewhere. Today, we will expand on the advantages of multi-funder DAFs with 3 case studies led by Tonic members. We will start with an introduction to the topic by Tim Frederick, President of Impact Assets. Then we will have 3 investment case studies, starting with Sea Forward Ocean Health Fund, investing in private funds and companies that focus on ocean health and sustainability. Then Shona Capital Multi-Donor Fund, focus on working capital loans to small businesses that create local jobs in Uganda. And finally, Unlock Ownership Fund, investing in innovative shared ownership models for community wealth building. After these 3 case studies, we will have some Q&A time, and I would like to ask you to help us manage the time well by entering your questions in the chat so we can group them together and line them up by Q&A time. And finally, Tim Friendlich will summarize the main innovative elements of this model and close the webinar. So with that, I'd like to pass it to you, Tim, for the overview of the model.
Thanks, Dario. So this, I think this helps kind of lay it out for kind of the flow of how it works. As Dario said, donors, other donor advised funds, foundations can all contribute into one donor advised fund. And so that's the sort of a hack of this is to create much lower participation levels potentially if desired, while also allowing with those smaller participation levels potentially a great deal of diversification in terms of portfolio activity, and essentially create almost a synthetic or virtual fund in a box without actually having to incorporate or create a limited partnership or LLC or any kind of fund structure. So what we are seeing is these donor funds are being set up with a technical lead or donor advisor as kind of the counterparty to the donor advised fund sponsor. And in our experience is obviously Impact Assets, where we're holding about $3 billion of donor advised fund assets as of this date across a couple thousand accounts. But increasingly what we're seeing, as Dario said, is a real interesting uptick in kind of pattern recognition of communities of affinity and passion coming together and very fluidly using this model to stand up a thesis and do it in a very fast way without legal complications, because it's all housed within this public charity environment where there is no sale of securities between individuals and a fund. In fact, it's just a charitable endowment that is being deployed, as you can see on the right side of this schema, into investments, into corporations, can be loans to nonprofits, investments go out to funds, private debt, private equity funds, and also can layer in grant-making activity to create a true full spectrum of integrated capital, potentially. But each one is sort of artisanally designed by its community and its leadership to create what the mix is of these. And it can evolve over time and be stood up in a matter of literally days in some cases, because you're not actually having to file fund documents and limited partnership agreements and all of that kind of stuff, and rigmarole, and can get just down to business. So the other feature of it is that these donor advised funds can actually employ contract consultants, researchers in some cases, and other service providers, legal plugins, to do the deal work and to monitor the portfolio and report back if it so chooses. In some cases, that's very much of a sort of pro bono volunteer driven activity by the community. But in other cases, we're seeing, this is a nice story. I'm looking at the chat. You had me at no lawyers, but basically we're seeing a really fluid uptake on these, and the ability to be kind of co-creative and use this model in a kind of a hacked way, if you will, to create these synthetic funds. And so I think that's sort of helpful scene setting to sort of understand the flow of what you're about to hear in 3 case studies. And with that, let me turn it over to, I believe, Laura, you're going to go first, right?
Yes, I am. Good morning, everyone. I'm really excited to be here. And just as a bit of background, my whole career has been focused on the ocean. For the last 27 years, I worked at NOAA, which is the U.S. Ocean Agency, National Oceanic and Atmospheric Administration, as a marine biologist and marine educator. And I had my first connection with the ocean when I was just a little girl. And ever since then, I've been extremely passionate about finding innovative ways to care for the ocean, which is truly our planet's life support system. The ocean provides so many benefits to us, including about half the oxygen we breathe, and provides a critical buffer for climate change. And through a very fortunate series of events, which I am tremendously grateful for, I was able to join Tonic and start impact investing in the ocean about 7 years ago through a donor-advised fund at Impact Assets. And I first started investing on my own, and then I co-invested with others into companies and funds. And every time we did this, we'd create a new donor-advised fund for each fund we invested in, and it got sort of confusing and a little bit inefficient, and it was really hard to track and understand impact. And so about a year ago, I was exploring ways to have a deeper and more meaningful impact with more of a systemic approach for how to address ocean health. And I was talking with Tim at Impact Assets and another co-investor, and we came up with the idea of this multi-donor fund that focuses on the least funded sustainable development goal, life below water. And in case you didn't notice in this picture, that's me in the bottom left there with a giant manta ray in Raja Ampat, Indonesia, which is one of my favorite places. And Dario, you can go to the next one. And so the idea of the Sea Forward Ocean Health Fund is to really be holistic, collaborative, and inclusive, and also be able to measure and share our impact in the ocean by having a very transparent structure with our investments. So we're really well connected with the science community for input on investments. We're providing an educational platform through our website at seaforwardfund.org and a newsletter to share and learn together about investing in the ocean. And so we've created this ever blue endowment for ocean health that will continue to reinvest into funds and companies and also make grants into perpetuity. And so by making one larger DAF, we can see where we're invested from a bigger systems level. And this has also reduced the management fees for each investor in the fund because it's based on a percentage of the total amount and spread across the entire donor advised fund. And so since a sustainable and biodiverse ocean benefits all of us, we've been working to create really a participatory and inclusive structure for the whole ecosystem of philanthropic capital. So we want more people to contribute to ocean health by working together for positive impact. And as you can see, the structure here allows participation at all levels. So for as little as $250, you can get your tax write-off, and then it opens up this world of impact investing to a much broader community. And so we currently have donor investors participating at all the levels that you see here. And our aim is to put more DAF dollars to work and make impact investing accessible to more people so that they can learn about it and really engage. So we're looking at trying to democratize participation and pull from the community to make investment decisions and support a structure for collective grant making. And this is kind of where I came from, is community input and engagement through NOAA and marine science and creating marine protected areas and things like that. And so it's in my nature to do this and to be involved with education. And so here are a couple of the funds that we're invested in. So the first two, my lead co-investor and I, we put our existing investments that we had into the Sea Forward Ocean Health Fund. And so we've been invested in Aquaspark, which is a well-established in sustainable aquaculture. We've been invested in that for about the past 6 years. So we have some maturing investments in the fund. And then we've invested in AIM for the past several years and put that investment in Sea Forward Ocean Health Fund. And AIM is more of a climate fund, but it invests in energy transition, carbon sequestration, alternative materials such as replacing plastic, food systems, including sustainable seafood, and data and digitization, and prioritizes equity and access. So some other funds were invested in. The next three funds are our newer investment. So we have 4 co-investors in the Hatch Blue Revolution Fund. And we really like this one because TNC, Nature Conservancy, is a conservation science partner, and it works with the team to measure impact of the investments. Blue Revolution Fund is just getting started, and they currently have one plant-based seafood investment, and we're looking forward to seeing what else comes up on the docket. And then Catapult Ocean they've been around for a while. They have investments in seaweed farming, microplastic reduction, electrification of boats, coral restoration. Propeller Fund is another newer VC fund, and they accelerate ocean climate companies by investing in transformational leaders. Propeller also has a really strong science partnership with Woods Hole and other universities to rapidly scale solutions. And then our one investment in a company is kind of a legacy from my co-investor, and we're mostly a fund of funds, but Scoot Science is an ocean data intelligence platform, and they do prediction of ocean conditions to protect sustainable aquaculture farms. And so we have a brand new collaboration that I'm really excited to share. This new initiative just launched last month with the Global Fund for Coral Reefs. And Global Fund for Coral Reefs is a little bit later stage fund, and they use blended finance to mobilize resources to protect and restore coral reef ecosystems. The Global Fund collaboration has commercial scale private equity fund and a complementary grant and concessionary technical assistance vehicle to catalyze impact. And so most of our other investments are in more venture and early stage. The Coral Reef Fund makes larger investments at later stage companies. And a sample investment of theirs is Carbon Wave, that upcycles invasive sargassum seaweed to high value biomaterials. And so the minimum investment in the Coral Reef Fund is $5 million. And so our idea in collaborating with them is to crowdsource smaller investments and make up the minimum. And then we'll make that larger investment once we have those all pooled together. And our Sea Forward Ocean Health Fund will match up to $250,000 of any new investments coming into the Global Fund for Coral Reefs. So feel free to jump in and get involved with that. And our whole philosophy at Sea Forward is to really be inclusive and collaborative with our donor investor community. We're working within different networks to collaborate, share, and measure our impact toward positive systems change for the ocean. Some examples of networks we're part of are the Thousand Ocean Startups Coalition that's created an Ocean Impact Navigator. And this is a harmonized KPI framework to measure impact across 6 main impact areas that affect the ocean. So examples are a clean ocean, a sustainably managed ocean, thriving and restored marine habitats, among others. And our Tonic Ocean Working Group is now using this Ocean Impact Navigator as a framework to share and collaborate on investments and look at where we can fill gaps and have a greater impact together. We also work with a science community. We work with the Brennan School of Environmental Management at UCSB and others, and mentor graduate level interns, one of whom just got a job at a big European ocean fund. So I'm thrilled about that. And we bring them in for scientific expertise to help assess investments and measure and share impact. And so with that, I'm pretty close to my time. I'm going to go ahead and pass it on to Sayuri, who's next.
Hi, this is Sayuri Sharper. I've shared screen. Dario, can you give me a thumbs up sign if you can see it?
We can see it, but it's not maximized.
Okay,
So
I will do that in a second. My computer is running very slow this morning. Does that work?
yes.
Okay, perfect. Hi, everybody. Let me start by saying hello to some of the SV2 partners that are on the call. I'd like to acknowledge that my whole impact journey started at SV2 when SV2 founded Impact Investing Working Group. So that was maybe 8 years ago. From there, I started mentoring at Miller Center and MIT for social entrepreneurs. Fell in love with these young people wanting to make a difference. Started making angel investment to a lot of these startup founders who at that time was mostly expat and repats, and then joined Tonic. So started realigning all my asset into impact. So I've had a 7-8 years journey in this space. I would say that when I started, it was all about investing in people that wanted to build large-scale businesses in Africa. So these are, again, expat and repats. But I felt like to build economy, what I really wanted to do is inject capital into the local economy. So it's not just these potentially high impact, high scale company, but also kind of the small businesses. Here you see our pictures that I took when I was in Uganda. I just got back this last weekend. So these are brand new pictures. So why Shona Capital, which is focused on small formal businesses in Uganda? Uganda has had a tough history. I don't know how many of you remember Idi Amin. There are certainly almost 10 years of genocide. I think people think of Rwanda as a place where genocide happened, but a lot of that happened in Uganda as well. So there was instability, ethics ethnic fights until really 1993. So they really had only 30 years of stability. Even though the fighting has lessened, the government is same guy running the government for over 20 years, and there's a lot of corruption. So if you are a person, whether you are educated or not educated in Uganda, and you want to find a job, only 10% of those that's looking for a formal job can find one. So the rest of the folks really need to depend on themselves and be entrepreneurs. So a lot of the folks, in fact, 80% of the jobs in Uganda are people working in informal sector. These are smallholder farmers, street vendors, anything you can do to make a living to support yourself and your family. And that is quite important. This is what we would think of bottom of the pyramid. But there's also folks that have the tenacity to start their own formal business. What that means is that you can grow this business, provide jobs, formal jobs to folks. And with these jobs, it comes with social benefits, and these business pay taxes. So I think that is a very important foundation of growing an economy to provide jobs and local wealth. The problem is that these small businesses don't have major assets, so they can't really get any bank loans. So there is very much a lack of working capital funding for these folks. So I actually started a pilot program with Shona Capital last April. And what we did was to start lending to these small businesses. The team is local, everybody is Ugandan. And of course, they have the expertise to find the right businesses to invest in. So I guess as of Q3 of this year, they have supported 33 businesses. And in fact, within those 33 businesses, created 220 direct jobs, working with 15,545 supplier folks. And with the loan that we've provided, within 12 years, they have grown their business 65%. So, certainly I was delighted by the result of this. And And then what we thought was that this is a great model that should be funded by not just my pilot initiative, but to bring this opportunity to more people who want to really engage and take part in growing the Africa continent economy. So because the money is recycled, I just want to point out that with 300K, which is what is in the portfolio now, this is recycled. So the result is the numbers you see are replicated every year. So for 300K, you can start 33 new businesses and the associated benefits. So the next question is why multi-donor DAF? It's actually kind of difficult to try to invest in local organization that is doing impact work. And in this case, it's impact with return. Because it's just hard to navigate through how you invest in a foreign company. On top of that, if this is catalytic capital, then and you want to use tax deductible funds, that's another big hurdle on how you deal with IRS on that. So DAF, multi-donor DAF is actually a great way to open up supporting local nonprofit or social enterprises easily. And what you get is that you get the due diligence by the impact asset team. So they have to accept, in this case, Shona Capital Fund, working capital fund as a investable investment within their platform. When you write the check to invest, it's to impact assets. So you will receive a receipt directly from them. And because we can aggregate the amount of funding, we're able to do this at minimum investment of 10,000. And all the investment you make go directly to Shona Capital. KSF Impact, which is my foundation, cover the administrative cost, which is minimized by the fact that it's one account held at Impact Asset. And you will receive quarterly report and semi-annual revenue share. So the revenue share is 30% of any of the revenues that Shona Capital gets from your investment. And the principal is returned in 3.5 years. So it's not a lot of commitment, and you get a return. And what you can do is with when you get back the principal and the revenue share, you can go ahead and use that to give to another philanthropic organization or keep on making other impact investment, including holding the money and reinvest that with Shona Capital. What I believe in and what the team in Uganda believes in is full investment transparency. This is a feature that the team is working on, but with once they set it up, you can track every loan portfolio and their performance, who has paid, what has been going on, how many jobs are created in each of these opportunities. So you really can see how your money is being used and what type of impact in near real time. So let me just show you some of the pictures of the company I visited. The top one is a logistic company. The Deli Cuts is a company that provides value add to meat products and cheese and sell that into supermarket, and they're developing their brand, Deli Cuts, so that the customer would know what to ask for. There is in the middle is a butcher shop. On the left is a bakery, and on the right is a pharmacy chain. And out of these businesses, 3 out of the 5 are female-led, and I'm happy to say that 42% of our portfolio companies are female-led. And by the way, female make the best borrower because they are always on time and have not defaulted. So their result is excellent. So we're trying to raise $250K more. The team has been able to deploy $400K so far, and they are looking to have a loan portfolio of $500,000 by the end of the year. So we are out of capital for further investments. So we are raising using the impact asset multi-donor DAF, and the next closing is December 31st. And would love to talk to you if you're interested in being part of this. Thanks, and let me turn it over to Brian.
All right, good morning, earlier morning or later in the morning, depending where you are. To everybody, it's great to see you and meet you all today. I'm Brian Boland with Unlock Ownership. Bringing you greetings from Amy Brakeman, who I know many of you know. She is traveling this week and wishes she could be here to spend time with you all, but she says hello. So she and I, among a couple others, are partnering on creating Unlock Ownership, which I'm excited to talk through with you today. We'll talk through 3 things. 1, why this area? Why is it interesting and why are we focused on it? Why a DAF and this multi-donor approach? And then 3, our approach to inclusive governance, which we'd love to cover today. So let's jump in and move to the next slide. So we became interested in these areas because it depending on where you look, the stats are all just overwhelming on how much inequality in the United States has grown. Not just these metrics, it's almost impossible to pick the right ones to tell the story around inequality because there is so much data around the growth, particularly in communities of color, of inequality. In fact, if you want to spend a whole bunch of time, the UC Berkeley has an online course on wealth and poverty that spends 13 classes of 60 to 90 minutes deep diving into the data and issues behind this growth of inequality in the United States. And it's a problem that we were trying to figure out, how do we play a role in? I came out of the tech industry and had built a number of businesses that really served small businesses, and became very passionate about trying to figure out how we address this specific issue of inequality in the United States. So if we look at the next slide, we tried to look at an understanding of what were the ways that we could solve the problem. The first effort that I did was to try to work with our federal government and try to work on the minimum wage. And it turns out that despite spending a lot of time with different Senate offices and chiefs of staff, we're nowhere closer than we were 5 or 10 years ago to passing an updated minimum wage. The policy arm is failing us, and it's not going to show up anytime soon. And so we can look at the markets and the private markets to see what avenues are there to build wealth in communities and to start to address this inequality. And one of the big levers that we heard from communities as we talked to them was really around changing the way we think about asset ownership. And so we can build wealth through employee ownership, because as an owner of a business or even a part owner of a business, you can participate in profit sharing. You actually see the culture of the business change. You can accrue value by your own stock ownership or co-op ownership in that company over time. And for homeowners, we know one of the greatest wealth building tools in the US is that you can have ownership of your home and build that equity over time. And so we've seen plenty of data over time around the opportunity that these 2 avenues provide to address these issues of inequality and to build that wealth through asset ownership and the way we think about ownership in the US. So let's look at the next slide. And the encouraging thing is that there's momentum. We're starting to see a lot of funds start to come together and different solutions that span different approaches on employee ownership or on home ownership. We're seeing the government has actually, in a lot of states, has passed legislation that is favorable to employee ownership. It's one of the only bipartisan things you'll see in this country is that people like small businesses and they like for people to be able to move that forward. And so there's this great ecosystem of funds that are showing up, but as we spent time with them and spent time listening to them, the thing that we heard was that there were a lot of bottlenecks for them to try to raise capital. It's not just their first close, which we heard was challenging to begin with, but it was also the capital they needed before the first close. Whether it's operating capital to pay their bills while they're spending time with investors to try to raise their capital, or that conversation that we hear time and time again, where an investor goes to a fund, they say, we love your ideas, you're a first-time fund manager, what's your track record look like? How many deals have you closed? And the fund manager says, well, we don't have any deals. And then the investor says, well, if I don't see your deals, I can't invest in your fund. And then you go round and round and round. So one of the ways that we've heard from our team that we can start to make a difference here is to start to provide other forms of capital, not just first close, where we think we can provide some meaningful support, but also in those earlier stages of helping people to prove their concept, to actually have some deals under their belt and to move things forward. So let's take a next slide forward. And we pulled together a clear mission that we developed in partnership with leaders in the field who actually work on this all day, every day. And we're really focused on solutions that accelerate the development of equitable asset ownership. And our goal is to bring this forward and to deploy capital quickly. One of the frustrations we heard from fund managers and from people building solutions is it takes so long for capital to be approved and to get out into the field that it takes forever to make a difference. And we want to help this move quicker. We want to help people be able to prove their concepts faster and be able to deploy into the ecosystem in meaningful and impactful ways even faster. So let's go to the next slide and talk about why what we're doing and why we think about DAFs. So with this capital, we can bring together multiple donors into a donor advised fund that can deploy into these businesses. You can actually take this multi-donor DAF capital, as long as the investments are mission aligned, that mission I showed you a minute ago, we can actually support the growth of these businesses and these ecosystems and homeowners that actually generate profit sharing and wealth for these communities that have historically been left behind. And we can provide that capital in all those flexible ways that we talked about, whether it's just investing in their fund or whether it's helping those funds or solutions get up to running. We can also provide grants to help de-risk those projects as they begin to grow. And as we look at this DAF sector, this DAF space, it's important to take a step back and realize that in 2022, it's estimated that there's $234 billion. Let me just pause on that. $234 billion that are sitting in DAFs. And the reality is that for these largest of financial firms that have DAFs, it's an incredibly lucrative business. And not only are these the largest financial firms, Fidelity Charitable is actually the largest charity in the world. And yet Fidelity makes $121 million a year, $121 million a year from managing their DAFs. And they make it hard. They've created a lot of friction for people to be able to deploy capital in these mechanisms and in ways that actually have positive impact. They can easily funnel you into the markets, but they make it harder for you to funnel into these places that actually build for a better society. That's why you've seen some of these newer organizations and now scaling, thankfully, like Impact Assets, who are changing that tune and are making it so that you can use DAF capital while it's waiting to be given away to be deployed for impact and for good. And so the goal here is to bring donors together and to bring experts in the field together to align a lot of capital in a way that brings forward asset ownership to build wealth in communities. So far, we have $5.5 million pre-launch committed. We're taking in donations this month, and then next year is our kind of big push towards fundraising. So we can go forward one slide. The other thing that we focused on is being inclusive in the way that we think of decisions made by the investment committee. And our fund is going to focus on a majority ecosystem-led decision-making process. So far, we have 2 leaders from the field, Smitha Das, who I know is very familiar with this community, and Santosh Ramdas, who's a leader in this field as well, along with 2 donors to begin with, where we will have a majority ecosystem-led, minority donor deciding process to actually allocate the funds that are in this donor advised fund. You see Amy's here as well, and we have another member who we're going to be adding and then may expand to a couple more. The point is to continue to be nimble, but also be able to listen and build a better process for what we should be funding and how. In fact, some of those examples I gave you of that earlier capital of being able to warehouse deals so that a fund can get up and running and prove their points or have operating capital while they're fundraising came from Smitha and Santosh, who work with these fund managers day in and day out and know the challenges that they see every day. So let's go one slide forward and close. Feel free to reach out. You can contact us at either of these email addresses, whether you want to just reach out through Unlock Ownership or to me directly. And whether it's for this fund that I'm talking about or the other funds that we talked about today, I think it's a really exciting opportunity for everyone to use DAF capital for good. And what's exciting about the way that these multi-donor DAFs are largely set up is that if you try to go through your traditional DAF provider and you try to get them to do an interesting deal, it is incredibly, incredibly, incredibly painful. If they let you do it at all, which largely they won't. The great structure about these, or that without exceptions I know about, you can simply set up a grant between your existing DAF and a major DAF provider and someone like Impact Assets or one of these funds. It's an easy, single kind of grant that gets you moving your capital in a way that you actually care about. So let's join together. Let's take this $230 some odd billion. Let's actually use it for good instead of propping up the stock values of the top shareholders in the United States and actually make a difference in our communities. Thank you so much for your time, and open to any questions via email or on this call.
Thank you so much, Brian, and all the presenters. Yes, let's open it up for questions. There was a question before about your commitment to potentially sharing returns, but also impact metrics from each of these multi-funder DAFs. So I'd like to ask the presenters how you're thinking about doing that and tracking both financial and impact returns.
I can go first since my structure is probably the most straightforward. So the way that you can get financial return is by getting the revenue share from the income that is generated from the lending process. So what we have modeled and estimated is that it's going to be between 5 to 7% return annualized. So those funds biannually will be paid out to the donor advised fund that's set up. And all the investors can then make a selection of whether or not they want those funds to be redirected to another nonprofit, or if you have a DAF in a different organization, to redirect to that, and Impact Asset will send those out. So that's the regular return. And again, in 3.5 years, you get your whole principal back. It's a catalytic investment, not really trying to be market rate, but it's a good return to create jobs using your capital.
I'll take a stab at that too. So with the Sea Forward Ocean Health Fund, most of our investments in funds they're 10-year funds. So the one that has the longest track record is Aquaspark, which is, I think, up about 14% from when we originally invested in it. And the other ones are newer investments. It's meant to be an ever blue endowment. And so the fund proceeds go back into the fund and are recycled to reinvest or give out as grants. But if you come in as a donor investor at $250K or more, you have the option of having your having proceeds go back into your own individual DAF. And so, and that's something that we have people doing that as well.
I like the Everblue. I was going to say evergreen, but now I'm torn. So there's two ways to think about the financial side of the fund. One is that there is this evergreen / everblue portion where we aim to be able to sustain, grow, and grant out of that portion. We also have the option for donors who come in over 250K to have principal recovered if that's important to them. We also have a similar kind of 10-year time frame that is conservative for now, and we'll learn over time as we see some of these faster cycle things come through if that can change or move forward. But we're thinking 10 years return of principal is the focus. From an impact standpoint, the good news / challenge is that all of these types of investments are highly measurable for a lot of different metrics. Whether we look at employee wealth creation, we look at profit sharing, we can look at surveys around culture. We can look at wages, we can look at the number of people who are in their homes, the amount their home has appreciated, et cetera. Out of the gate, we'll be able to share the reporting that comes in from the investments individually, and then would love help with new donors on defining what sort of aggregate reporting and what sort of narrative would be helpful for people to see how all these different slices of impact come together.
Thank you so much, everyone. So before actually going to the next question, I would like to launch a poll. So if you vote for any of these options, we can follow up with the slides for the presentation and also include the contact information of the presenter. So we'll leave the poll there and go to the next question. And team, there were some questions in the chat about limitations on private market investments by DAFs. And you mentioned that at Impact Assets, there are virtually very few. Would like to expand on that, but also share like the problem that you're solving in the industry, following up on what Brian mentioned about the limitations that are that traditional DAF providers have for impact investments.
Yeah, I mean, if you think about it, it's quite, I mean, it's very frustrating and yet also quite reasonable, the friction that is out there. You've got small community foundations that are built around community philanthropy and relationships and have a sort of almost an externalized investment capability that's usually some Cambridge Associates consulting something and don't have a purpose-built engine sort of embedded and integrated into the entity to do complex transactions that are private debt and equity. So although it's frustrating, it's also, it makes sense that there would be that issue. And the issue with Fidelity Charitable or any of the national ones is a little different. They obviously are kind of grown out of investment houses and theoretically might have some of that capability, but they're not venture capital firms. They're public markets. It's actually not really their bread and butter of their sort of affiliated financial services firm. So, I mean, that was Impact Assets' kind of hypothesis was what if you purpose built of by and for impact investing from every staff person, every client, every donor, every board member, what could you do if you had the will and the capability and capacity? And we're seeing some other really, bright anecdotal spots of some earlier stage DAF sponsors coming online that I think will also be doing this kind of activity. I know, Brian, they're working with one out of Colorado, and it's really not. I mean, if you think about like a Ford Foundation or a Heron Foundation, I mean, they're investing their corpus and doing program-related investing across all sorts of private asset and alternative asset classes. There's nothing about being a charitable endowment that is, kind of structurally unable to do that. It's just a question of have you built sort of by and for that. So, that's kind of my big kind of existential response is just, it's lack of will, and we're going to change that because the market is voting with all of these amazing initiatives. The next generation of donors want to do impact investing. If you look at all the polls, it's like Millennials and Gen Z, it's like this is they're impact native, if you will, as far as investing goes, much more so than maybe generations preceding. So these sets of demonstrations and successes of getting to scale will flow through the community foundations and the national sponsors of donor advised funds, and we will see more and more of that $234 billion coming online into deeper impact investing over the years. But it is, it's at the moment it's quite a constipated environment, if you will.
Thank you so much. There is another question in the chat by Adam Jokaski about the pain points or some of the operational challenges with getting this structure off the ground. I don't know, Tim, if you want to take the question now, or maybe while you do the closing, maybe you're going to touch on those points. What do you prefer?
Yeah, I can hit it in the closing, I think.
Okay, so if you do it in the closing, then let's open it up. If somebody has a spontaneous question that would just want to mute and ask to the any of the presenters or to Tim, please go ahead.
I put one in the chat, but I think these are all really interesting, and I'm curious what you're doing, each of you, to get the word out about this, and if Impact Assets is helping in that regard. And yeah, so seems like that's a challenge.
Hi, Tony. I'll answer that question from my perspective. It is really hard because it's not something I'm good at. I work well with social entrepreneurs, and I can identify the need because that is my passion. But getting the word out, that's tough. And trying to get Impact Asset to do it is probably not going to work because they have so many folks are interested in doing the multi-donor DAO structure. I think these type of seminars where we're one of the example certainly bring awareness to what we're doing, but would really love someone to advise me on how to get the word out.
I would agree. It's a challenge, and hopefully this webinar is one step toward that. We had about 60 people online, and I think 100 people sign up. So you can all help us get the word out about these opportunities, and yeah, just in your conversations and other ways, and website and LinkedIn, and yeah, that's how we're doing it. But it's definitely work in progress.
Yeah, and for Unlock Ownership, we're just getting started. So next year is going to be our full-on push, as we're just getting started this month to kind of close out this year and then really start to both deploy and raise next year. I think there's a couple of things. One, the exciting aspect is that you've got some other trailblazers on this call who are earlier to doing these multi-donor DAFs, but you're now starting to see them pick up. And I think people are realizing that capital can be deployed differently. And so I expect this conversation to grow. I do think it's important that we all really challenge each other and challenge our peers into how they think about their DAFs. The reality is, for a number of folks, is that they think about their DAF in December or November when they are finalizing their tax planning, and they do it to get the tax write-off. And then what I've heard from some of their advisors is they don't think about it again. And it's sitting somewhere doing, who knows what. So I do think the conversation is shifting and changing. I do think it's on us to really challenge that conversation and figure out how we take this taxpayer subsidized capital and deploy it for the betterment of the people who've subsidized these large DAFs. So we'll be marketing, we'll be doing the conferences around this topic. We're starting to build up a lot of word of mouth, and then we'll be doing more traditional marketing type work.
I think the good news is that as you can see through these discussions or these case studies, the distributed nature of these, and the chance of going sort of a barn raised viral, if you will, is much higher than in a conventional structure. And also because we're within a charitable endowment, you don't have a lot of the securities regulation issues that you would have if you were out there trying to sell a fund to, a private fund to accredited investors, et cetera. So, there are characteristics of it that do lend itself to building a wave of momentum societally, I think, and being successful if we stick with it. And I'll also say that although we would love, and I'm sure everyone would love to, almost have an unlimited amount of capital in the thesis that they're passionately organizing around, these can work and evolve at a relatively skunkworks level and build, on their own time frame. So they don't have these kind of like really fast, needs to get a subscription done in X amount of time per se. They're not running a ton of carrying costs. They can scale incrementally. So that's also positive. I will say we're certainly looking into this as evidence in this call and our support of some of these initiatives, and doing what we can. Mr. Harry, I appreciate your comment. It is like we're an enablement platform. We're not a broker deal. We're not a marketing platform. We're a community of donors, and we're trying to make connections and figure out ways to shine a spotlight on and participate in sort of moving the needle in terms of awareness.
Tim, why don't you bring us...
I think the other funds are different because they're collaborative, jointly investing funds. But in terms of Shoner Capital to do the work continuing forward, we actually do need kind of immediate action to get the team the next 150K so that they can keep growing. Their target is to get to loan portfolio of $1 million next year, and that will get them to be profitable and sustainable going forward. So anybody out there, if you have friends, if there is a group of people you think might be interested, do contact me and we'll be happy to share how this multi-donor fund works with any of you. So be out there spreading the word. It would be very, very much appreciated.
Tim, why don't you bring us to a closing and touch upon also operational challenges, but there were also a number of questions about the fees structures. So if you can touch on all of that as you close up the webinar.
Yeah, and I think if you just pop to that second slide of the last three set, we can skip the first one. No, the one back one.
This one?
To the pie chart. Yeah, that one. Yeah, I mean, I think we've done about 40 of these of different varieties, some of which are actually far in the past and started like SV2 or New Media Ventures as examples, but most are relatively new. But we're already up to above $100 million in them collectively. And just on my scanning of the groups that are in there, they expect, and I believe they will at least double the asset base just in impact assets in the next 12 months. So I would see that in the 200 to 250 million range because most are just getting going. And that's without new. I mean, we have 6 in the hopper right now that haven't even gotten set up, but we're seeing them across such, I mean, one of the comments that someone made in the chat was like, the opportunity is vast. I mean, it really is. It's like any community of funders with any thesis, whether it be early stage, late stage, more concessionary, more market rate, whether it be concerned with racial equity, gender equality, climate solutions, we're seeing them all already. And this is like the earliest adoption, moment of this. In 10 years, we'll be talking about, I'd love the idea that why not create a fund-to-fund multi-donor DAF that can then fund all of them so that you can just click and be part of this amazing, kind of a collective action. I think that's actually really possible. The fees and costs, they just run like donor advised funds, basically, just to keep it simple. And you can see the fee structures on impact assets, but $1 million DAF runs at about a percentage point a year in terms of its administrative costs and doesn't have any other legal or accounting expenses. It's all baked in there, just for simplicity. And they tend to trend down. $10 million donor advised fund, can trend down to less than that, 80 basis points, 70 basis points. Smaller ones can be a little more expensive. And I know people do have to leave, but I would just leave us with the call to action, which is definitely all three of these are amazing initiatives with great collective leadership. And people to reach out. I think there were emails on the slides and in the chat. And if you have a passionate community or network and a theme that you want to hit or a geography, my email's in there. I'm happy to talk with people. I do think that, what Brian mentioned, that the opportunity to be co-creative and to go deep on impact and to be kind of catalytic at a systems level, like finding out what emerging managers need and not just writing a ticket into their first fund, but giving them working capital. I mean, doing grants like Laura's starting to do with C Forward. Really, the sky's the limit to design this around a more sort of decentralized, autonomous DAF, if you will, a DAO DAF, to meet a much more fast-acting and fast-moving and sort of fearless thesis. So again, I think we're at sort of the first moments of these coming together, and we're going to see a lot more of this. And I look forward to, revisiting this conversation maybe in a year or 2 years, Dario, and talking about a whole landscape of dozens and dozens of these kind of multi-donor initiatives. So I appreciate everybody coming on the call, and thanks.
Thank you, everyone. It was great spending some time with you and learn about this exciting new structure. If you'd like to contribute to any of them, you should have received the email addresses that in the chat. If not, please contact me, and we'll love to connect you with any of the presenters. And we hope to host similar meetings like this one in the future. So stay tuned for future programming by Tonic. And thanks, everyone, for being with us today.
Bye-bye. Thank you.